Hello everyone, this is Christian Reyna with Reyna Property Group, and today I'll be going over our multifamily development model. Before I start, I think it'll be helpful to share a little bit of background about Reyna Property Group. We are a real estate brokerage and investment consulting firm based out of New York City. Our brokerage side specializes in New York City real estate, and our consulting arm, we've had the privilege of working on engagements globally in North America, as well as Africa, Latin America, and many major metros in the US. We cover a wide range of asset classes, all major asset classes, as well as investment strategies, everything ranging from core acquisitions to opportunistic development and adaptive reuse and repositioning. As in addition to both sides of the capital stack, I should add. To date, we have engaged on over $1 billion of investments. We've had the pleasure of working with clients ranging from solopreneurs to ultra high net worth individuals to private equity funds to family offices. And we created our investment consulting arm, recognizing the need for institutional quality analyses in amongst smaller players in the real estate market, and really just democratizing the insights learned in investment banking, corporate development, and private equity, and bringing that to all real estate players, no matter the transaction size. So we've worked on transactions ranging from the low hundreds of thousands to several nine-figure transactions and major multi-use development deals in key metros in the U.S. But with that being said, let's jump into the model. So this model is a multifamily development model, which is intended to underwrite deals effectively and not to showcase our ability to create models inundated with assumptions and showcase our aptitude for financial modeling. We really wanted to create a model that was palatable to most investors and be able to handle the vast majority of use cases. So starting off, the model has 10 tabs total. The summary tab is comprised of many of the assumptions that you will input into the model, though we do have some supports assumptions that will be found on the subsequent tabs. But the summary is pretty straightforward. We have our property information here, our investment assumptions where we can input an acquisition date, disposition month, exit cap rate. We do have several NOI capture methods here. So we have forward 12, trailing 12, and trailing 3. In the event you decide to opt to choose trailing 3, it will take the previous 3 months and annualize it by multiplying by 4. Additionally, we have closing costs, and because this model is meant to accommodate both solopreneurs as well as real estate private equity funds, we also include the GP and LP equity split contributions here. Construction financing, the model assumes that initial construction financing is interest only, floating rate based on the interest rate index of SOFR, the 1 month forward or whatever. If you decide to do 3 month, that's fine as well, with the accompanying fees, a prepayment penalty, and then finally a cash sweep. So during lease up, when the property begins seeing cash flow, you can use that excess cash flow to pay down the accruing debt on the construction financing. And so if I set this to 100, if we have 50,000 in excess cash flow in month 20, for example, that 50,000 will be allocated toward paying down the investment debt, the construction financing. Then we have the refinancing. So we can choose to include permanent refinancing in month 30. In this case, because month 30, this is driven off of the lease-up schedule, which we will cover on the revenue tab. Again, the forward 12 methodology, or you can opt to choose the trailing 12 or trailing 3 month as well for NOI. Evaluation cap rate to arrive at a property value at refinance. And then we have our loan constraints here, namely the minimum debt service coverage ratio, minimum debt yield, and maximum LTV, before arriving at the most conservative of them all, which would be the in this case, the debt service coverage ratio constraint, taking the minimum loan amount that meets all of these requirements. Then we have interest rate inputs, interest only optionality, amortization, maturity, loan origination fee, exit fee, and a prepayment penalty. Over here, we have our sources and uses, with all of these being driven largely from the development budget tab, and the sources and uses are broken up by the dollar amount, the per unit amount, per gross square foot amount, and the rentable square foot amount, and of course the percentage. That's always helpful. We have our total development budget here, and then a project timeline with the major milestones, the occupancy rate at each milestone, the start month, and then the corresponding date. We have our unit mix, which will be inputted on the unit mix tab, which we will discuss shortly, and then a pro forma snapshot, particularly highlighting the pro forma at stabilization, refinance, the sale month, outlines the NOI margin, the NOI capture method, the cap rate, the property value, and then some loan metrics here as well. In addition to cash on cash return, we have a disposition summary, so our project costs compared to the sale price, and then our dollar change, and then our percentage change as well. We have asset level returns in addition to levered returns. So in this particular deal, in this illustrative deal, we see that leverage is working positively here via the IRR. We have stabilized return on costs, and then development spread as well. And then of course partnership returns, and this is pulling directly from our partnership returns tab. Lastly, we have a sensitivity analysis where you can toggle what metric you want to sensitize based on the disposition month. So here, these are pulling what our active assumptions are, and then you could toggle your center values on the sensitivity here as well. Moving on to the unit mix, so nothing flashy here. Again, we want to make this model as easily digestible and inheritable as possible, and this allows for augmentation pretty easily to update it for whatever your specific use case may be. But here you can input up to 10 units. Of course, if you want to add more, that's as simple as adding rows. And then we have a rent comparable section here in which you can input your rent comparable. So in particular, we thought it would be useful to, of course, include square footage and asking rent, but also concessions, because that's a big part of many developers' lease-up strategy, especially in more competitive markets, or when there's a case of a market may slow. Thinking back to COVID 2020, when many apartments in downtown Manhattan were offering up to 4 months free rent. So we include net effective rent as well. Then we switch this to 0. Net effective rent will just be equal to asking rent. And then we have accompanying metrics as well. For each set of rent comparables, we track the min, median, average, and max. And then over here, this will juxtapose whatever you input here with the data summary from here. So in this case, we're seeing that we have the minimum asking rent here is $1,600, and we've inputted for a studio monthly rent of $1,950. So there's a difference of $350. We're charging $350 more than the minimum of our comparable set. Over here, again, very straightforward. We have our sales comparable table, and this includes the property name, street address, the build year / latest renovation, units, total square footage, sale price, and then our sale price based on the unit amount, and then on a square foot basis as well. Additionally, we have again another matrix just illustrating how our underwriting looks compared to our market comparables, just to make sure we're using sound assumptions and our outputs are reasonable for what the market is currently showing. To our revenues tab, this will pull directly from the unit mix tab, which we've already discussed. Here is the lease-up schedule. So the lease-up schedule, you can manually input when the lease-up start happens, and then how long the lease-up period would end, and then at this month, this would be stabilization. We have a table for ancillary income, other income, up to 10 inputs. as well as the revenue escalations for rent and then other income, in addition to the revenue adjustments, so vacancy, collection loss, concessions, and then other loss as well. And this can be, and again, we can simply add a row here and then update the table as well below. And then we just see how these line items will flow throughout the course of the development. And so here we see lease up starts at month 19, and we see how the lease up is completed. And then once we reach there, we do start to pull the stabilized vacancy, hence why when the percentage of the construction is complete and the lease up is complete, our actual occupancy in this particular year, we're in year 3, we're underwriting a 5% vacancy, hence why we're showing an occupancy of 95%. We have similar functionality for the expenses, and again, we can input up to 10 expenses. We have a toggle for an input for expense growth, as well as property management fee, and then property taxes as well, keeping this nice, clean, and simple. And again, this will be, and in the case of, I think it's worth mentioning, we have the optionality to include which expenses will be variable and fixed and which will be both. So insurance, obviously this is fixed, marketing, fixed, but of course something like utilities, there is going to be a baseline. The property is not going to dip below, but obviously this will grow as tenants begin to move in and occupy the property. The utilities will go up, and so this will track depending on how you decide to input the assumption. Utilities will grow in tandem with occupancy depending on the variable amounts. So here we have the development budget, and this is just going to be the developments, all of the development cash flows for the land acquisition, the hard costs and the soft costs. But if we expand this section here, this is where the model is particularly helpful, because there is a toggle that will allow you to, I closed it by accident, 1 second. The model will allow you to choose the projection type between straight lines. So in this case, let's pull a case of down here, capitalized property taxes, insurance, and marketing are straight lined, whereas here we have a bell curve, and the bell curve is just in between. So we have a start month of month 1 and month 18. In between there, that is when the highest concentration of cash flows will occur. So let's just take a look at site preparation and demo, for example. We see it reaches a maximum of around 65,000 before tapering off again. So it starts low, gets high, tapers off again, and that reflects a little bit more of what you will see in reality, particularly among the hard cost. Moving on to financing. So financing, this is where we get a look into the equity draws, the construction loan draws, in addition to the financing, and then the operational cash flows as well. So this is where that cash sweep functionality comes in. When we start seeing these cash flows, we can pull this cash flow by changing that assumption on the summary tab to update, to be able to pay down some of this debt here in this line item, the cash sweep to pay down interest. And then here we have an optionality to input our SOFR curve from wherever you decide to pull it from, and it'll pull the SOFR, the spread, which is also inputted on the summary tab, the interest rate, and then the monthly interest rate. And of course, the interest, which is capitalized, will be a function of the monthly interest rate here. And permanent financing, that will occur at stabilization. That is our underlying assumption, our baseline assumption in this model. And so once this model is underwritten to stabilize in month 30, that is when we'll issue, that is when we'll pay down the debt. And so we see we're issuing a permanent financing loan of $56 million. Again, that comes from the loan sizing on the summary between the debt service coverage ratio, the debt yield, and then the maximum LTV. And then this pulls here, we're showing 24 months of interest only, hence why we have interest only. After 24 months, now we see the full debt service kick in, and that is good to go there. Next, we have our amortization table. And this is just helpful to see. Some people like to see it vertically in the case of the permanent financing summary. So what you see in this financing table here is exactly the same, just shown differently. Of course, this tab can be hidden to the extent you don't want to use it. But typically people just like to see this here, and see the balloon payments as well, though that flows into the model seamlessly anyway. Finally, we get to our pro forma on a monthly cash flow basis as well as an annual cash flow basis. Nothing too fancy here. All of the supporting calculations on the previous tabs will feed into this model before arriving at our unlevered return metrics, in addition to our levered return metrics. And then the annual cash flow tab is a summation of all of these. And again, we see that here as well, tracking the IRR, equity multiple, and profit, cash on cash return, unlevered as well as levered, and then partnership returns here. And again, this is pulling directly from the, let's move this over a bit. This is pulling directly from the input from the equity contribution here. So GP contributes 10% of the equity. That flows in directly to here. We have total levered returns of 100%, just as a check. The GP contributes 10%, LP 90%, and then these are our hurdles here. So this is a 4-tier partnership structure, waterfall structure. So we have the preferred return at 10%, tier 2 IRR, and so on and so forth, with the corresponding promote structure. And then their difference, this is just a check making sure that all dollars have been distributed accurately and that the model is flowing correctly. But the general consensus of this model, it was not to showcase our ability of building extremely complex models, though we do recognize that there are sponsors that do need to do more granular analysis, and of course we can augment this model to meet the needs of those particular clients. So for example, if you initially decide to do construction financing and want to include preferred equity or mezzanine financing, we can seamlessly incorporate that as well in the event. Some of the smaller players that we work with in the real estate market, sometimes once they don't want to look at IRR, that's not really digestible outside of the institutional space. So what a lot of people do is they may do the waterfall structure based on cash or equity multiple, and so we can update the waterfall structure in that regard too. Or if you really want to be somewhat fancy about the partnership return structure, we can incorporate in tandem the equity multiple in addition to IRR. And so this model is meant to, again, fit most use cases. I think it's a pretty easily understood model, and that's generally what has distinguished us from other players in our industry, is that we let the models be digestible, easily understood, and that hasn't failed us so far. And our clients definitely appreciate being able to understand and articulate their investment strategy to relevant parties, whether that's investors or lenders, in a way that doesn't feel like a PhD level math course in real estate investment. But I think that's everything I want to cover. If you have any questions, feel free to reach out. And thank you. I look forward to being able to underwrite deals and bring your investments to life. Our mantra is we make deals come true, and we do so by being client-centric and understanding the needs of our clients to help achieve outsized returns in this real estate market. So thank you, everyone.